Cool. So, hi guys, welcome back. So today we're talking more about some micro macro questions. We're going to go over some commonly asked questions, find the right answer, explain it, and then go over some of the previous year's answers to make sure that they got it right and they're all in line with what we found. So, that being said, let's just jump right in to that first question. So the first question says, if expansionary taxation policies encourage growth, are they always appropriate to implement? And answer choice 1 says, yes, the private sector can easily and affordably replace all services and facilities cut by the government. 2, yes, the government will still ensure that individuals and businesses continue to receive all necessary services. 3, no, government services could create inflation, which decreases the purchasing power of consumers. Or 4, no, government services could be reduced and cause serious problems for individuals and businesses. So really quickly, let's first understand what is expansionary taxation policy. And essentially, there's 2 parts to that. Expansionary policy refers to policy taken by the government that is aimed at driving up aggregate demand, right? Increasing consumer spending, increasing investment spending, etc. And so that's the first direction. We're encouraging growth, right? And the second component is taxation. What kind of policy that's involving taxation would lead to that kind of expansion? And the answer to that would be tax cuts, right? If we cut taxes, we're reducing the amount that people have to pay out of their income to the government, and that increases the amount of disposable income, and effectively income has gone up. And when income goes up, we know that spending goes up for normal goods in the economy. Okay, so we now understand what expansionary taxation policy means. Are they always appropriate to implement? And so some of the trade-offs are going to be talked about in some of these answer choices. And one of them is that, yes, reducing taxation increases the amount of disposable income for individuals, but it decreases the amount of budget revenue or amount of money that the government has to pay for government programs. And so there are a lot of things that the government spends money on, anything from welfare or entitlement programs like Social Security or Medicare, Medicaid. Not sure if Social Security actually counts as entitlement, but along those lines of public services. There's investment in roads, education, the military. So a lot of these things require money. And so the question poses, is it always appropriate to implement these types of expansionary taxation policies in order to encourage growth? And the answer is most likely no. To a certain extent, at a certain point, once you decrease taxes by too much, you're going to lose the amount of money necessary to support some of those vital, important services that only the government can provide. And we know that government provides some services because they're public goods, and there's the tragedy of the commons, and a reason why the private sector won't replace those goods or the services. So let's go down the line and see which one of these answer choices best fits that explanation. The first 2 answer choices both say yes, it's always appropriate to implement, so we can eliminate those because our answer is that no, there is a point in time where you would want to stop using expansionary taxation policy. 3 says no, government services could create inflation, which decreases the purchasing power of consumers. Again, it's unclear why expansionary taxation policy would directly lead to the type of inflation that would decrease purchasing power of consumers to the extent that it outweighs the increase in their disposable income from paying less in taxes. So we're not really sure about that one. And 4 says no, government services could be reduced and cause serious problems for individuals and businesses. And this seems like a much better answer. Again, it touches on the idea that there are certain services and things that only the government can provide, and if the government lacks the funding to provide those services, it won't be able to provide those benefits. So 4 is going to be the best answer here. Let's move on to the previous tutor's answer. And the previous tutor says 4 as well. And they said the expansionary taxation policy involves a reduction in the tax rate such that the purchasing power of consumers is enhanced, and subsequently aggregate demand in the economy is stimulated, that eventually rescues the economy from recession and the environment of low profitability. Expansionary taxation policy also encourages growth by allowing businesses to keep a larger portion of their profits that can be invested in the economy. However, one major drawback of this fiscal measure is the reduction in revenue receipts that creates a budget deficit and hence increases government debt. This will ultimately lead to a reduction in government services, which may cause serious problems of businesses and individuals. And again, we also want to note that note that we don't believe the private sector could provide all the services that the government provides because of the tragedy of the commons and public goods, among other reasons. Okay, but otherwise the solution is correct. You can mark that as correct. Okay, the next question says, a surplus of a product will arise when price is blank, right? And so a surplus is when quantity supplied is greater than quantity demanded. We can draw this out on a graph. So we have our demand curve, our supply curve, and this is our equilibrium point, right? And so if this is where the quantity demanded would be equal quantity supplied. And surplus, let's mark this, would be where quantity supplied is greater than quantity demanded, not at this equilibrium point. So we would actually expect it to be somewhere like this, right? At a higher price level, we would have this quantity would be quantity supplied, and then this quantity over here would be quantity demanded, and our surplus is the difference between these two quantities. So the answer to this question then is that a surplus of a product will arise when price is greater than the equilibrium level, right? At any level in which the price is above this equilibrium, P star, you're experiencing a situation where quantity supplied is greater than quantity demanded. Okay, let's now go to the answers given by the previous tutor. The previous tutor says there will be a product surplus when the price is too high. Think about the question. You go to buy something, the price is too high for you to pass. A surplus is up because you don't buy, so quantity supplied is greater than demand for quantity. Whenever demand is less than the amount supplied, you get that surplus. So if equilibrium is equal to quantity supplied is equal to quantity demanded, you raise the price and demand goes down, you get a surplus. So I think this is a pretty scattered answer. We're gonna write a version of this that might more accurately explain what this question is probably trying to say, or what this previous tutor is trying to say. So if we draw out a supply and demand graph, we know that at equilibrium, when supply intersects demand, the quantity supplied is equal to the quantity demanded. For a surplus refers to a situation where quantity supplied exceeds quantity demanded. On the graph, this only occurs at prices higher than the equilibrium price, and we can draw this out and see the price line intersecting both the demand and supply curve to give us this scenario. Okay. I mean, at the end of the day, the solution is correct. We're just going to provide this addendum of what we believe I'm just gonna mark it as incorrect, so I hope that somebody will replace the solution here. So that we can get this more accurate explanation in. Okay. Next question says, the price of a good will rise if A, supply of the good decreases, B, the price of a substitute for a good decreases, C, demand for the good decreases, D, there is a surplus of the good, or E, the good is an inferior good and income increases. Okay, so we're looking for a situation in which, I'm not sure how we got back here. Looking for a situation where price rises, right? So let's look at each of these scenarios. So first, the supply of the good decreases. So let's really quickly draw this out. We have our demand, we have our supply, and we're saying supply decreases. It's a leftward shift of the supply curve, something like that. And we have a price increase, right? We used to have an equilibrium level over here. Now it's over here. So we do have a price increase. So that looks like a pretty good candidate for our answer. But let's just check the rest of the answer choices to make sure. B says that the price of a substitute for the good decreases. Again, let's understand the definition of a substitute. A substitute is basically another good for which consumers believe that this good and that good are replaceable of each other. They could be substituted for one another. You're indifferent between which one you get. A good example might be like, I don't know, lemons and limes, although there is a difference, but let's just say for the sake of argument that people don't care whether or not they get lemons or limes. So let's say limes is our primary good and lemons are the substitute. If the price of the substitute good decreases, that means the price of lemons goes down. What does that mean in a lemons market? In a lemons market, the price goes down. Law of demand tells us quantity demand goes up. Okay, perfect. What does that mean for us in our primary good market, the limes market? Well, we know that people come to the market and they don't care if they buy limes or lemons as long as they get one of them when they go home. And we know that people, because the price is lower for lemons, are buying more lemons. Therefore, if you're already buying more lemons, you don't see a need for limes, which are to you the exact same thing. So you buy less limes, and that's going to be a leftward shift in the demand curve for our lime market, right? So leftward shift in demand would look something like this, and we see a price decrease, and so that's not going to be a good answer for our question. C said demand for the good decreases, and we just established that a decrease in demand would not give us that price increase, it would be a price decrease. D says there is a surplus of the good, and we went over this in the previous question, right? But a surplus means that your price is something higher than the equilibrium level, and barring a price control like a price floor, you would actually expect that given this surplus, the pressures of the market would force the price to decrease in this market. And the reason for that is because you have people who are you have suppliers who have a surplus of inventory, and they're going to be putting those into the inventory for future periods because they can't sell, and they would rather just sell that in this current period, right? And so in order to do that, they see there's people who are willing to buy at a lower price, and they would rather sell it by the end of this year than just keep it and throw it away, right? So they lower their price, and there's that downward pressure, and someone's going to buy it. And they can keep lowering that price up until the equilibrium point, at which point there's no more buyers if you continue to lower the price, and that's when it stops. So that downward pressure continues to exist for this surplus situation until you have reached equilibrium again. And so this is not going to cause the price of the good to rise, it will cause the price of the good to fall. And finally, the answer choice E says the good is an inferior good and income increases. Again, let's take a look at this on the graph. We have our supply and demand curve, and this is a market for an inferior good. Well, what do we know what happens when income increases for an inferior good? Inferior good by definition is a good where if you have higher income, you would purchase less of this good. So that is reflected in a leftward shift in demand, right? It's and it's shifting to the left. And again, just like in this graph over here, we see that that's going to lead to a decrease in price, not an increase in price. So A is still the only answer choice, which gave us that rise in price, and so we're going to go with A. Let's go with the previous tier's answer. Previous tier says that the correct answer is A. The prices of many goods are inversely related to the supply. They tend to rise when the supply decreases. They tend to fall when the supply increases. Answers B, C, D, and E do not describe the relationship between price and supply. And so it's less so that B, C, D, and E don't describe this relationship between price and supply. It's more so that they simply don't lead to a price increase, right? It's not that the other answer choices don't describe the relationship between price and supply. It's more that they simply do not result in an increase in price. Still correct answer though, so we'll mark that as correct. Next question says, suppose demand and supply are given by the function QD is equal to 60 minus P and QS is equal to P minus 20. And part A says, what are the equilibrium quantity and prices in this market? And so, again, what is the rule for equilibrium, right? At equilibrium, At equilibrium, we know that at this point, quantity demanded, QD, is equal to quantity supplied, right? And so what that means is we can just set these two equations equal to each other, because QD is equal to 60 minus P, QS is equal to P minus 20, and we know QD and QS at equilibrium are the same. So we get, let's type this out instead so that it's a little bit easier to read. You get something like 60 minus P is equal to P minus 20. We can add P to both sides. We get 60 is equal to 2P minus 20. And then you can subtract 20 from both sides. 40 is equal to 2P. And then finally, divide by 2 on both sides. P is equal to 20. And then we have the equilibrium price, and we also want equilibrium quantity. So because QS and QD are the same, it doesn't really matter which one we plug back into. Let's just do QD. So QD is equal to 60 minus P, which is equal to 60 minus 20, which is equal to 40. 40. So we have our two answers here. Equilibrium price is at $20, and equilibrium quantity is at 40 units. Okay. Let's check that with the previous tutor's answer. So previous tutor said, this is our two functions based on equilibrium. We know that these two are the same. You know, go through this whole process. Oh, did I do some bad math? I did do some bad math. It's not subtract by 20 on both sides, it's add by 20 on both sides. So instead of getting 40 here, it would be 80. And this is a price of 40, and then plug this in, we would get a quantity of 20. My bad, guys. That was mistake. But right, so now we do math. We get P is equal to 40, equilibrium price is 40, and then I'll plug that into the QD equation, 60 minus 40, the quantity is 20, and that's the answer to the first part. So ignore my prior explanation where I made a bad mistake, and this is the correct answer here. The next question or part says, determine the quantity demanded, the quantity supplied, and the magnitude of the surplus if a price floor of $50 is imposed on this market. And so, well, we can first visualize this on the graph. We know here, right, that, can I draw? Okay, yeah, we know here that this equilibrium price is at 40 now, and we know that this equilibrium quantity is at 20. So what does a price floor look like at 50? It's gonna look something like this, right? So we can expect that quantity supplied will be high, quantity demanded will be low, and we're gonna have some sort of surplus, right? So let's do the math now. Math tells us, let's start with the quantity supplied. So the quantity supplied is given by P minus 20, QS is equal to P minus 20. And we know that the price is at a price floor of $50, and we know that there's no way the price naturally goes above 50, right? So the price will be the lowest it can possibly be given this price control. And so the price floor of 50 means price is equal to 50. So we get 50 minus 20 is equal to 30. So quantity supply is equal to 30. QD is next, 60 minus P. We get 60 minus 50 is equal to 10, so that's our QD. And finally, the magnitude of the surplus is simply going to be the difference between quantity supplied and quantity demanded. QS minus QD is equal to 30 minus 10 equal to 20. And so that's going to be the magnitude of our surplus. So we have 30, 10, and 20. Let's see what the previous tutor said. The previous tutor said quantity demanded will be 10. Right, plugging the value of the price floor into the demand function, we get 60 minus 50 is equal to 10. Due to imposition of the price floor, quantity demanded decreases from 20 units to 10 units. Okay, now plugging the value of price floor into the demand function, we can derive, I think that means supply function here. Supply function, we can derive P minus 20, 50 minus 20 is equal to 30. And so the surplus quantity is 30 minus 10 is equal to 20. So perfect, we got the same thing. And then finally, the final question is determine the quantity demanded and the quantity supplied and the magnitude of the shortage if a price ceiling of $29 is imposed. Also determine the full economic price paid by consumers. And so if we want to draw this out, it's again going to look something like this, where you're going to have a low quantity demanded, a high quantity supplied, and you're going to have the shortage, and then finally you're going to have this price over here, which is the price that consumers end up actually paying. So that's everything that we have to calculate, right? Let's draw this out one more time in a text box. Okay, so we have, let's start with QD. QD is equal to 60 minus P, and in this case, we know that P is equal to 29, so 60 minus 29 is equal to 31. And QS is equal to P minus 20, and we know that P is equal to 29, so 29 minus 20 is equal to 9. And then the shortage is equal to D minus QS is equal to 31 minus 9 is equal to 22. So its shortage is 22. And finally, we want the price that consumers pay. So we plug in the quantity into the demand curve to see what the price would be. So QD is equal to 60 minus P. We set QD equal to 22 because we know that's the quantity. And then we say, what is P going to be? Sorry, it's not 60 minus P, is it? Right, so the price is going to be the right, so the price will actually be the intersection of the price floor onto the curve. So because the price is capped at $29, we just know that the ending price is $29 as well. And I think if we put that all together, we would get 54, I think, for the overall economic price being paid by consumers. Let's take a look at the previous tutor's answer. So the first part of this question is using, where does it start? Okay, price ceiling of $29. We calculate this on the demand curve. We get quantity demand is equal to 31, okay? Next, we use this on the supply curve. Plug in 29 for price, we get quantity supply is 9, and then we get the shortage as the difference between quantity demand and quantity supply. The excess amount of demand is 22 units, and then we can plug in the quantity supplied of 9 into the, right. So we plug this into the quantity demanded equation, and we would get 60 minus P, and we know that, I think this would be easier if we, if I just redrew this graph. So this is just for part C. So we have our demand, we have our supply, we have equilibrium. This is price 40, this is 20, and then we have on part C a price ceiling, 29, gives us quantity supplied here, and quantity demanded here. We just calculated this. Quantity demand is equal to 31, and quantity supply is equal to 9. And we want to know what the economic price is for these consumers. And so we would basically want to draw this line up from the quantity supplied level to this price over here to see what would consumers be paying if it weren't for the price ceiling for this good, right? And so we would get 9 plugged into a quantity demand equation. 60 minus P is 60 minus 9, so 51 as the economic costs. And so the economic price paid by consumers is $51. Okay, great. So I think we matched up very well with all of the previous tutor's answers, and so we can just mark that as correct. Okay, next question says, explicit costs are payments the firm makes for 1, outputs such as desks for its employees, whereas implicit costs are expenditure costs that occur for services such as travel expenses for its employees. 2, outputs such as desks for its employees, whereas implicit costs are non-expenditure costs that occur through the use of self-owned resources such as foregone income. 3, inputs such as wages and salaries to its employees, whereas implicit costs are non-expenditure costs that occur through the use of self-owned resources such as foregone income. And 4, inputs such as wages and salaries to its employees, whereas implicit costs are expenditure costs that occur for services such as travel expenses for employees. So what we're really trying to contrast here are a difference between explicit and implicit costs, right? First thing we have to deal with is whose costs are these? And we're doing with this from the firm side, from the supplier side, right? So the costs that we're talking about are costs for inputs into production, right? Outputs of a firm are going to be a result of both implicit and explicit costs. It's the inputs such as wages or inputs such as resources required to produce a good, like raw materials. Those are the costs that are explicitly noted, right? And so we can draw a parallel between explicit costs and accounting costs, which are things that you're actually paying for, right? Like with money. And so those are your explicit costs. Your implicit costs, however, are your economic costs, the things that you are giving up, the opportunity cost of your decision. It's not money per se, that you aren't spending money on these implicit costs. It's more so a foregone opportunity to make money somewhere else. And so that's the real big difference. And so let's go down the line and see which one of these answer choices best matches up with this definition of explicit versus implicit costs. So the first thing we notice is that both 1 and 2 talk about outputs, right? And we already noted that explicit costs are for inputs. It doesn't really make sense to classify them as costs of outputs. And so 1 and 2 are both going to be incorrect. Now 3 says explicit costs are inputs such as wages and salaries for employees, which is true. And they also talk about implicit costs as non-expenditure costs occurring through the use of self-owned resources such as foregone income. And this is also true, right? Foregone income is definitely an opportunity cost of pursuing some sort of venture. So let's just check number 4 to make sure. 4 says inputs as well, and it says implicit costs are expenditure costs that occur for services such as travel expenses for employees. Again, that's something that you could bill, like objectively bill onto an accounting book. So that's not really going to be implicit, it's more so explicit. So 3 is still going to be the best answer here. And the previous tutor also said 3. And they said that there are 2 categories of costs, namely explicit and implicit costs, which collectively make the total cost of production for a firm. Explicit costs are out-of-pocket direct expenses that are made on various factors of production, especially variable factors. And the wages and salaries paid to employees are paid in cash and hence represent explicit expenditure. Implicit costs are non-expenditure costs that occur due to the mere existence of an economic action, or I would say choice. There are certain factors that do not exhaust resources directly, such as self-owned factors. For example, if an economic agent uses his or her own property to start a business, he or she didn't pay himself or herself explicitly, hence did not incur any explicit costs, but at the same time, they forgo the income they could have earned from the property by renting it out. That's true. So this opportunity cost of action forms the implicit costs. Good answer, right? It covers the basis of what we were talking about, the difference between explicit and implicit costs. Okay, great. Next question says, what does fiscal policy most closely focus on? 1, controlling the money supply. 2, managing taxes and spending. 3, limiting business transactions. Or 4, controlling commercial banks. It's a good question, right? So it really is just a definition question, the contrast between fiscal and monetary policy. So fiscal policy is stuff that the central government can do in order to either stimulate demand or shrink demand, right? And this is contrasted with the monetary policy approach, which is powered by the Fed, which is mostly trying to accomplish the same goals, but using the money supply as a tool instead. So we know right off the bat, 1's not going to be right because that's monetary policy. And here's just really a definition kind of thing. Fiscal policy refers to either control over taxes or control over government spending, and changes in either of those things will change the amount of spending that occurs in the economy. And so we're looking for something like that in the answer choices, and it looks like answer choice 2 is the best answer, right? It says managing taxes and spending. And so those are both of the kind of tools that government has to engage with when they're talking about fiscal policy. Let's take a look at the previous tutor's answer. They also said 2. They said that Fiscal policy refers to the use of government revenues and tax policy to influence the state of the economy with the motive of maintaining long-term price stability, full employment, and catalyzing economic growth by correcting short-run economic downturns. When an economy slows down, When an economy slows down with low aggregate demand, that leads to plummeting business activity, or it heats up due to its increasing aggregate demand beyond its productive capacity, the state takes actions that are within its capability. Such actions are considered instruments of fiscal policy. The government can change its level of spending or a tax rate to influence the level of consumption spending. When government spending is increased investments absorb unemployment from the market, and a rise in the number of consumers leads to an increase in aggregate demand that rescues the economy from recession. The opposite is done when the economy undergoes a high level of inflation. Similarly, when the tax rate is decreased and the increase in the disposable income of consumers incentivizes consumption spending that leads to an increase in the level of aggregate demand, the opposite is carried out when the economy experiences inflationary pressure, right? So this is a good answer. It breaks down the situations in which you would use both types of policy well, and nothing really much to add in that arena. The next question says, in the market, actions known as incentives affect 1, only consumers, 2, only producers, 3, producers and consumers both, or 4, neither consumers nor producers. And so in this case here, we're talking about incentives as things that motivate certain types of behavior, whether it be positive or negative behavior. And so can it affect consumers only, producers only, or both, or neither? We know that there are incentives out there that can affect both producers and consumers. We can imagine things such as sin taxes, which are levied on consumers of addictive goods like alcohol or cigarettes, and that would be a negative incentive to decrease consumption of those goods. It doesn't ban the consumption of those goods, but it definitely talks about reducing the incentive to buy those goods. You also have positive incentives for producers. Subsidies given to producers to produce certain goods are an incentive to affect how much the producer is going to naturally be willing to manufacture in the market. It's not a mandate, it's simply a push in that direction, right? So we can see that there's definitely examples of incentives affecting both producers and consumers. So 3 is going to be the best answer here. We can look at previous tutor's answer, and the previous tutor said 3 as well. And they said an incentive acts as a motivator for any action. A market creates incentives which affects both the producers and consumers. All the agents of a market are incentivized to involve themselves in market activities. Incentives can be financial, which provide a material reward to the agent, or can be moral incentives that reward in terms of a sense of self-esteem, admiration, or satisfaction. A market mostly creates financial incentives. Consumers have an incentive to engage in the market due to their needs and desires, whereas producers have the incentive to do the same to maximize their profits. And so certain examples of incentives include sin taxes and subsidies, which would affect both of the supply, producer, and consumer sides of the economy. But the answer is correct. The next question says, the most efficient combination of resources in producing a given output is the combination that A, comes closest to using the same quantities of land, labor, capital, and entrepreneurial ability. B, minimizes the cost per unit of output. C, uses the smallest total quantity of all resources. Easy. Or D, conserves most on the use of labor. Right, so let's break this down. We're talking about efficiency here, most likely allocative efficiency, and it's basically saying we want a situation where we are most efficiently using the resources at our disposal. And so what does efficiency mean? And so A says that efficiency would mean using the same quantities of land, labor, capital, and entrepreneurial ability. And this is a really bad metric, right? Because obviously, depending on what you're producing, some things might be more land intensive and some things might be more labor or capital or entrepreneurial intensive, right? For example, growing crops is very land intensive, kind of labor intensive, kind of capital intensive, and not very entrepreneurial ability intensive, right? And so by that logic, it would be inefficient to use land to produce farm on land, even if that was the most adequate use of those resources. And so A would be incorrect. B says minimizing the cost per unit of output. This is a much better metric for efficiency. If we're minimizing costs, we know that there's not much else we can do to drive down the production cost of this good. And so this is going to be a really good indicator that we've done our best to most efficiently combine the resources at our disposal. So we're going to keep an eye on B. Let's take a look at C. C says use the smallest total quantity of all resources. And this is inherently inefficient, right? If you use a very small quantity of resources, that means you're leaving some of your resources unused. And that would be, under most definitions, inefficient, because you could incorporate those resources in a certain way so that you could increase your production overall. And so we would not define efficiency by using the smallest total amount of resources. And D says conserves most on the use of labor. And again, it's unclear why efficiency would entail paying specific attention to just one of our factors of production, just labor, right? Why not land? Why not capital? And so this isn't really the way we view efficiency. It's again going back to the idea of minimizing cost per unit of output. And so B is going to be the best answer choice over here. And the previous tutor also said B, and they said this is done by buying the inputs which have higher marginal outputs. And yeah, it was a good answer choice here for sure. The next question says, which calculation helps determine which producer has the absolute advantage? 1 says amount produced divided by resources used. 2 says amount produced minus resources used. 3 says resources used divided by amount produced. And 4 says resources used multiplied by the amount produced. And so let's start with what is absolute advantage. And we know that absolute advantage refers to a situation where between two producers, one producer can produce more of a single good given the exact same amount of resources. And so we think about it as just a raw potential to manufacture a good, right? Who can manufacture more given the same amount of resources? And so which one of these calculations is the best way to determine that outcome? A says amount produced divided by resources used. And so this is more so a ratio of how many resources are used to produce each unit of the good. And this is more so, I guess, more so towards comparative advantage than absolute advantage. We don't really care about the efficiency per unit of resources. We care about overall ability to produce, right? And so 1 doesn't really get that relationship correct. 2 says amount produced minus resources used, and this seems to be a kind of a better indicator, right? That overall, how much can you produce minus the amount of resources you use controls for how many resources you have, and it gives us back the answer, who can produce more goods overall, right? And so 2 seems to be a better answer here. 3 says resources used divided by amount produced, and again, it seems unclear. It basically is again telling us the ratio between how many resources are needed to produce each type of good. And so this is more so again towards comparative advantage, less towards absolute advantage. And then answer choice 4 says resources used multiplied by the amount produced. And so in that sense, we're again dealing with a situation where we're unsure why this calculation would yield us an absolute advantage. I wouldn't even really know how to define the output of that kind of calculation for multiplying resources and amount produced. So we're going to stick with 2 as the best answer here, the amount produced minus resources used. And we can take a look at the previous tutor's answer, and the previous tutor said amount produced minus resources used as well. And they said that an economic agent possesses an absolute advantage in the production of a good or service if it can produce a greater quantity of the good or service using the same amount of resources or the same output with a relatively smaller quantity of resources compared to its competitors. Absolute advantage is derived from the input requirements per unit of output. Hence, the absolute advantage can be determined by comparing the difference between the amount of output and resources used for different economies. The theory of absolute advantage was given by Adam Smith in his 1776 book, The Wealth of Nations. And so this is the correct answer, and nothing much to add there. Next question says, economists use the term inflation to describe a situation in which 1, incomes in the economy are increasing, 2, stock market prices are rising, 3, the overall level of prices in the economy is increasing, or 4, the economy is growing rapidly. Again, this is a definition question. When we talk about inflation, what do we refer to? And we normally refer to it as an overall increase in the level of prices in the economy. And so which one of these answer choices best matches that? It's going to be answer choice 3. There's not really much else to really compare here. That's simply the definition for inflation. And so that's just something that you guys are going to have to work on and remember when you're taking the test. So looking at the previous tutor, we also said 3, and they said a situation in which the general price level of goods and services in the economy experiences a sustained increase over a given period of time is known as inflation. A moderate rate of inflation is ideal as it keeps the productive sector motivated and economic activity healthy, but when the inflation rate increases beyond its ideal figure, productivity increases fail to become explicit and economic growth is diluted due to discouraged demand from rising prices. Consequently, inflation increase leads to an erosion in the real value of money by weakening purchasing power. So again, it's a good explanation, pretty in-depth. We didn't really need to know, for this question at least, the impacts of inflation. But yeah, it's good that they wrote that out. I'll mark that as correct. The next question says, suppose the market for cars is unregulated. That is, car prices are free to adjust based on the forces of supply and demand. If a shortage exists in the car market, then the current price must be blank, then the equilibrium price. For the market to reach equilibrium, you expect blank. So let's draw this out. We have a car market, we have our demand and supply. That's a P, that's a D. And so they're free to adjust. If a shortage exists in the car market, what does that mean? A shortage means that there's too much demand, not enough supply. Immediately you know that the price is going to be below equilibrium. It gives us this high quantity demanded and this low quantity supplied, and this is a shortage. The current price must be lower, right? Lower than the equilibrium price at P star. And we know that for the market to reach equilibrium, we know that this is an unregulated market, that we expect the price to increase until it reaches the equilibrium point once again. So this is our graph and understanding. So the answer would be lower and then increase. So the next question, the previous tutor's answer says, if a shortage exists in the car market, then the current price must be lower than the equilibrium price. For a market to reach equilibrium, you expect buyers to offer higher prices, right? So pricing, you expect increase in price. The explanation that they give is that prices below the equilibrium generate excess demand because buyers are willing to purchase more cars than sellers are willing to sell, i.e. the quantity supplied is less than quantity demanded at that price. Some buyers who wish to purchase cars at the current price will be unable to do so. In order to obtain them, some buyers will offer higher prices. As buyers bid prices upwards, some sellers will be willing to sell additional cars. Thus, the market will move towards the equilibrium quantity, whereas the quantity of cars demanded by buyers, where the quantity of cars demanded by buyers equals exactly the quantity supplied by sellers. Great answer, really touches upon the important points, and we mark that as correct. The next question says, we do not see complete specialization in the real world because 1, not all goods and services are traded internationally. Production of most goods involves increasing opportunity costs and tastes for products differ. 2, not all goods and services are traded internationally. Production of most goods involve constant opportunity costs and tastes for products are remarkably uniform. 3, not all goods and services are traded internationally. Production of most goods involves decreasing opportunity costs and tastes for products differ. 4, all goods and services are traded internationally. Production of most involves increasing opportunity costs and tastes for products are remarkably uniform, right? And so in this case here, dealing with a situation where we have basically 3 factors to consider as reasons why we don't have complete specialization. So quickly, what do we mean by complete specialization in the real world? So when we break this down into like a two good model or international trade model between 2 countries, complete specialization would be if a country were to direct all of its resources towards the production of one good, and another country produces all of its resources to the production of another good, and then they trade and get kind of goods from each other to reach a higher bundle. And so that would be complete specialization, dedicating yourself to only producing one kind of good. Whereas semi-specialization would be that you orient a lot of your resources towards one type of good, but you're still producing other goods at a lower level and you're trading to get more of the other goods, but you don't completely specialize where you are kind of taking away all of the resources from other goods and directing them just towards one kind of venture. And so let's break this down into the three categories given by the answer choices, which is trading goods internationally, opportunity costs, and tastes. So for internationally, what does international trade have to do with specialization? Well, we know that specialization actually only occurs for goods in which there is international trade, because otherwise you'd be unable to produce or access goods that you are not producing yourself. And in that sense, specialization in one type of good is wasteful because you'd probably prefer to have more of a range of goods to choose from, right? And so specialization only occurs for goods in which there is international trade. And so a reason we might not see complete specialization in the real world is because there are some goods which are not traded internationally. So that would be our first criteria. Second, there's this idea of opportunity cost. Is it constant? Is it increasing or decreasing? And we know that if we look at the production possibilities frontier, for example, that this curve of the production possibilities frontier is because there's increasing opportunity costs. That as we produce more and more of one good, we're increasing the amount of trade-off we get of producing other goods. And so we know that opportunity costs are increasing, and we know that we have the largest opportunity costs when we completely specialize, because we're all the way on one side of the spectrum rather than in this bowed area where you could have a mix of goods. And so if you go all the way to one spectrum of the good, then it would be incredibly hard for that type of opportunity cost to be worth it, right? And so increasing opportunity cost is another reason we wouldn't really see complete specialization. And finally, tastes for products. How does that impact the type of goods that are produced? And we know that it might be the case that we cannot access all of the goods we want from trade alone. Like, there are certain goods that we must produce ourselves, and so in that sense, it doesn't make sense to forego production of goods that we have very strong tastes for in favor of goods we have weaker tastes for, just for simply the sake of trade, because we wouldn't be able to access the most efficient or highest consumption bundle that we would want. And so tastes for products are also different. And so we want to look for an answer choice that combines those three factors together. The idea that not all goods and services are internationally traded, the idea that there are increasing opportunity costs, and the idea that there are different tastes for different goods in the real world. So let's take a look at the different answer choices. I think answer choice 1 already makes that pretty clearly the right answer. Not all goods and services are traded internationally. Production of most goods involves increasing opportunity costs, and tastes for products differ. Right, so 1 is going to be the right answer here. And the previous tutor also said 1, and they said that the theory of comparative advantage advocates specialization in the production of goods and services. An economy can produce at a lower opportunity cost than others, such that the surplus of the same can be traded with other economies for goods and services in the production of which the economy in consideration is at a comparative advantage. This is encouraged such that scarce resources are put to their best use and benefit is maximized when in trade. However, complete specialization is never achieved, as not all goods and services find a demand in an international market. An economy is hence compelled to produce certain goods and services exclusive to its culture. At the same time, there are increasing opportunity costs in the production of most goods. This prevents absolute substitution of resources for the production of a certain baskets of goods and services. Tastes for products differ according to numerous factors inherent in different countries. All of these reasons prevent complete specialization collectively. Okay, that's a good answer, and we're going to mark that as correct. And the next question says, which of the following is not included in M1? And M1 is a way that we define money supply, and so it's looking at the most liquid types of money. So which one of these is not considered a most liquid type of money? A says currency, B says demand deposits, which are basically just checking accounts. C says traveler's checks, which are checks that can be cashed immediately. And D says credit cards, which are basically the cards you use to kind of accrue payments and pay at a later time. And so the answer to this is going to be D. And the reason that credit cards are not included in M1 is because we don't consider credit cards to be money, right? A is currency is money, demand deposits are money, traveler's checks are money. Credit cards are not money, they're a tool. And what they offer you is the ability to offload your payments to a later point in time and pay later. But it's not really a form of money, right? It's just a tool. So D is going to be the correct answer here. And we can take a look at the previous tutor's answer. And they also said D, credit cards are not included in M1. Okay, great. Answer choice 2, when a government purchases $200 worth of government bonds, when the Fed purchases $200 worth of government bonds from the public, the US money supply eventually increases by A, more than $200, B, exactly $200, C, less than $200, or D, none of the above are correct. And so the answer to this is going to be A, more than $200, and the reason for that is something known as the multiplier effect. So when the Fed purchases $200 worth of government bonds, what it's doing is it takes back paper and it puts in $200 into banks, right? The banks that are holding the bonds. And so banks now have $200 more in deposits, and based on the reserve ratio, they can probably loan out anywhere from $100 to $180 worth of additional loans, and then those loans get turned around and spent somewhere, and people who are receiving that money to go and turn around and spend it somewhere else. And so this multiplier effect is going to happen where this initial influx of $200 is amplified by the multiplier effect into becoming a much higher increase in money supply. So A is going to be the correct answer here, more than $200. And taking a look at the previous tutor, they also said more than $200 happening due to the multiplier effect. 3 says savings and deposits are included in M1, A, M1 but not M2. B, M2 but not M1, C, M1 and M2, or D, neither M1 nor M2. So we're gonna see that savings deposits are gonna be deposits which have a limitation on how often or how much you can withdraw. And this is opposed to demand deposits where you can withdraw immediately. And so the savings deposits, because of these limitations, are considered to be a little bit less liquid. And so they're not M1, but they are going to be considered an M2, which is a broader definition of money that has more illiquid types of money. And so B is going to be the right answer here. Savings deposits are included in M2, but not M1. And so B is the correct answer here. And the previous tutor also said B as well. Okay, we can move on to 4. Credit cards, A, defer payments, B, are a store of value, C, have led to wider use of currency, or D, are part of the money supply. And we talked about this in part in question 1, but credit cards are a tool for deferring payment. They're not currency, they're not a store of value, right? Credit cards themselves are just cards, and we don't consider them as methods, as a thing that is worth money in and of itself. It's simply a tool to give us a way of paying for things. It has not led to wider use of currency. Credit cards, because they are allowing you to defer payments, mean people can carry less currency. And also, again, we said credit cards are not part of money supply. So A is the correct answer here. And previous tutor also said A. Question 5 says it gives us this table. And they say the reserve ratio for this bank is 0, 20, 80, or 100%. So we have on this T chart, we have assets on the left side, liabilities on the right side. Our assets are divided into $2,000 in reserves, $8,000 in loans, and our liabilities are $10,000 total in deposits, right? So the reserve ratio is calculated by the percentage, the amount of money in reserves divided by the amount in deposits. And so 2,000 divided by 10,000 is going to give us 20%. So the correct answer is B. The previous tutor also says B, right? 2,000 divided by 10,000. Okay. Question 6. If an economy uses silver as money, then that economy's money, A, serves as a store of value but not as a medium of exchange, B, serves as a medium of exchange but not as a unit of account, C, is commodity money, or D, has no intrinsic value, right? So this is kind of going into the different roles of money. So A says store of value, and what that means is that this money holds value over time. So if you're using silver in this economy today, will it still be worth money in the future? And the answer is yes. That silver as money will still store value in the long term, be considered a valuable material, right? So it's going to be a store of value. And it's a medium of exchange. A medium of exchange is a role of money where people recognize that this money is worth something, and it's useful in facilitating exchanges of goods and services, right? So before this, we had bartering, and when money came along, offering something as a medium of exchange allowed you to facilitate transactions even if I don't have something that you want. I just have money that you want, right? So silver, there's no reason that silver would not serve as a medium of exchange, so A is incorrect. B says medium of exchange, and so that's still a role that silver plays, but not a unit of account. And again, a unit of account is saying something that we can is divisible and can have objectively observable value. And we know that silver used to be divided into ingots and they used to be divided into bars, and so we know that we can look at how much each is worth by weight, by amount, and so it is going to be a unit of account, so B is also going to be incorrect. C says it's commodity money, and commodity money is basically defined as a system where the money you're using has intrinsic value. And so this is opposed to fiat money, which is money that is representative of value but doesn't have any intrinsic value. And fiat money is the most common type of money we have today. Paper currency by itself is just paper, but we know that it represents money, right? So that's commodity money. And so this seems to be a good answer here because silver by itself does have value, and so commodity money is a good definition. And finally, D says no intrinsic value, but we just talked about the idea that silver does have intrinsic value, which is making it commodity money. So C is going to be the correct answer here. And the previous tutor also said C as well, commodity money. D says that in the United States, currency holdings per person average about A, $125. One explanation for this relatively small average is that many people use credit or debit cards to make transactions. B, $125. One explanation for this relatively small average is that U.S. citizens hold a lot of foreign currency. C, $3,700. One explanation for this relatively large amount is that criminals probably prefer currency as a medium of exchange. And D, $3,700. One explanation for this relatively large average is that U.S. citizens hold a lot of foreign currency. This is just kind of a fact check. I don't think it's going to be very commonly asked as a question. I had to look this up. The answer is C, $3,700, because criminals prefer currency as a medium of exchange. And I didn't know that before. So that's going to be the correct answer, though. And so the previous tutor also got C as well. 8 says money is the most liquid asset available because A is a store of value, B it is a medium of exchange, C is a unit of account, or D it has intrinsic value. Again, liquid means its ability to be used immediately to buy most goods. And the function that is most tied to that is B, the medium of exchange. And what that means is that we recognize money as being something acceptable when engaging in transactions, and that's what makes money liquid, right? So B is the correct answer here. 9, all Fed purchases the previous tutor said medium of exchange as well. 9, all Fed purchases and sales of A, corporate stocks and bonds are conducted at the New York Fed trading desks. B, government bonds are conducted at the New York Fed trading desk. C, real estate and other real assets are conducted by the Federal Open Market Committee. Or D, all of the above are correct. Again, this is a really fact-checked based question. The correct answer is B. It's just something that you have to know, that government bonds are conducted at the New York Fed trading desk. And so the correct answer that the tutor previously got is also correct at B as well. And finally, 10, the Fed's policy decisions have an important influence on A, inflation in the long run and employment and production in the short run. B, inflation in the long run and employment and production in the short run. C, inflation in the short run and employment and production in the short run. Or D, inflation in the short run and employment and production in the long run. So we know that policy decisions that the Fed makes are going to impact inflation, and it will be in the long run that we see those changes, because we don't expect there to be an immediate impact on the market due to a Fed's policy decision. So only in the long run will we see the effects of that. But employment and production are very, very sensitive to changes by the Fed, such as changes in the interest rate or something like that. And so those are concerns that will be met in the short run. And so A is going to be the best answer here. Inflation in the long run and employment and production in the short run. And the previous tutor also agrees with that answer. So looks like the previous tutor got all the questions right. We're going to say good job and mark that as correct. And I believe that is all we have for today. So hopefully that was helpful. I'll see you guys again on Thursday. And I hope everybody's staying healthy and safe at home. Take care, guys.